Well, you know what? We will talk to our panel of experts on the jobless claims number and this new news. Rick Santelli, of course, is with us. Glenn Hubbard, former Council of Economic Advisors Chair and Columbia Business School professor, is with us. Austan Goolsbee is with us, also former CEA Chair and Chicago Booth School of Business professor, and Kate Moore, head of thematic strategy at BlackRock, and our own Mike Santoli. Professor Hubbard, what's your sense of both the jobless claims number and the firepower we're now hearing from the Fed?
Well, I think we expected very high jobless claims number. My own math was a little over 6 million, so pretty close. The question is not how bad it is, it's really bad, but how quickly it can turn around. And that's mainly about health policy, but it's also about economic policy and incomes. On the Fed, the 2.3 trillion is about 5 times the total capital, 10 times the partial capital. The Fed's got 2 questions, though. One, the Main Street loans have to get made before the Fed can buy them. And second, 10-to-1 leverage is going to be awfully high for the portfolio that Steve Leisman talked about, unless the Fed plans to lose more than its capital.
Austan Goolsbee, is the money that we're seeing coming out of the Fed and out of the government going to be enough, given the jobless claims numbers that we're seeing?
I don't think so. You know, this is a savage number, and this ties effectively the biggest number of all times by a factor of 10. 1/10 of this number before 2 weeks ago would have been the worst jobless claims we ever had. And this is probably still an underestimate of what the unemployment situation is, because in state after state, you've completely overloaded the unemployment insurance system. You've got people lined up in the state of New York, for example. You have to physically talk to someone. You can't just do it online. And you've got people reporting they've called 200 times to try to get through and file an application, and they just get a busy signal. I think the Fed is doing what they should do. This was already baked in, I think, because this is exactly what the money was that they announced. And I just think monetary policy, the whole monetary policy channel, is so not antiquated, but is not really directly appropriate to the nature of the shock that's happening here, that I don't think it's going to end up being enough.
Kate, how's the investment community thinking about this number, the Fed reaction specifically today?
Yeah, I have to say, all of these waves of policy programs and support are really encouraging investors. We've seen strong performance from the market over recent days. A lot of that has been based on, better health news, but also this promise of continued policy support. And I think this announcement we just got this morning gives that to us. The other thing that investors are going to be really focused on, frankly, is the guidance from companies coming out of earnings next week. We have the first quarter earnings starting off. And while we don't expect maybe companies to give firm guidance for second quarter or third quarter, because we don't know exactly what the path of the virus will look like, the tone from companies and their experience in their first quarter will tell people a lot about what it's going to take to recover. And I think that'll make it a lot easier for investors to start pricing assets.
You're optimistic, it sounds like, Kate.
I'm modestly optimistic. We're still running a relatively high level of cash to our history, but we're looking for opportunities. And I have to say, every time we get a big bang policy response like this, and the market's going to react a little bit positively, it shortens the time, it dampens the pain, and it leads us to believe that we can get back to something that is closer to normal activity over future quarters instead of future years.